All right, welcome back. In our last explainer, we really dug into how fear, that feeling of loss aversion, can make us totally irrational with our money. Well, today, we're flipping the coin and tackling its opposite, and honestly, probably more dangerous counterpart, our own ego.
So let me just start by asking you a question. And I want you to be really honest with yourself here. Do you think you're an above average driver? It's funny. In study after study, somewhere around 90% of people say, yes, absolutely. Now, that's just statistically impossible, right? I mean, we can't all be better than the average. It just goes to show you we have this fundamental bias baked right into us.
So let's bring it back to what we're here to talk about. Are you an above average investor? If your gut reaction was yeah, probably, then you've just walked right into what might be the single most expensive trap in all of behavioral finance: overconfidence. So here's the game plan for today. First, we're going to tear down this above average illusion. Then we'll look at the excuses our ego loves to use to protect itself. After that, I'm going to introduce you to the ultimate antidote, a simple journal. And finally, we'll cover a few ways to start thinking like a professional.
Okay, let's dive right into this first trap because it is truly the root of so many investing mistakes. It's that powerful nagging belief that we know better than everyone else.
At its core, overconfidence is just our tendency to think we're better than we actually are. In the markets, it's that little voice in your head whispering, I can beat the market, or I've got a knack for finding the next big thing. And yeah, it feels good to think that, but it leads to some classic, really costly mistakes.
So mistake number one is overtrading. This is when you believe you can perfectly time the market's every little wiggle, so you're constantly buying and selling. There's a famous study by Barber and Odin that found the investors who traded the most actually earned the least. Why? Well, because every trade costs you money, and more importantly, it's just another chance to be wrong. And mistake number two, poor diversification. This is when an investor gets an idea in their head. I've done the research, this stock is a sure thing, and they just bet the farm on it.
And if you want a perfect and honestly a tragic example of this, look at Enron. Thousands of employees poured their entire retirement savings into their own company's stock. They thought, hey, I work here, I have an inside track. They were overconfident, and when that company collapsed, they lost everything. That is the devastating price of overconfidence.
So you have to wonder, if overconfidence leads us to make these big mistakes, how does our ego even survive the hit? Well, it's got a couple of really clever psychological tricks up its sleeves to protect itself. This slide just captures it perfectly, doesn't it? It's our brain's internal monologue. When an investment makes money, we immediately take the credit. My analysis was genius. I totally timed that perfectly. But when we lose money, oh, no, that's never our fault. It was bad luck, or the market was manipulated.
And here's the real danger. This bias creates a nasty feedback loop. If our losses are always somebody else's fault, we never stop to fix our strategy. We never learn. And since every single win is just more proof of our genius, we get even more overconfident for the next time around.
And that brings us to the ego's other favorite trick, hindsight bias. Just think about the 2008 financial crisis. Back in 2007, things were messy. There was massive uncertainty and disagreement. But fast forward to 2009, suddenly everyone's an expert. Oh, it was so obvious the housing market was a bubble. We literally rewrite history in our minds, forgetting all the confusion and just remembering the outcome as if it were inevitable. This I knew it all along feeling, it's the ego's sweetest trap. Because if we can convince ourselves that we saw the past with perfect clarity, our overconfidence just skyrockets. We start to believe we can predict the future too, completely forgetting how chaotic and random the world really is. So it's becoming pretty clear that our biggest enemy in investing isn't the market. It's us. It's our own ego. But the good news is it's not a lost cause. You can absolutely manage it. So let's talk about some real concrete strategies to do just that.
Okay, the single most powerful tool you can use is an investment journal. But don't even call it that. Think of it as your proof notebook. Here's how it works. Before you buy anything, you sit down and you write out these 5 things. What you're buying and at what price. Your thesis, like why you think it's a good idea. And then what is the specific risk that would prove you wrong? And finally, your exact exit points for both a loss and a win.
And what this simple little exercise does is it systematically blows up all those ego traps we just talked about. When you lose money, you can't just chalk it up to bad luck. You have to look at your journal and ask,
Did the exact risk I wrote down actually happen? And when some big market event happens, you can't say, I knew it all along, because you have written proof of what you were really thinking. It forces you to be honest with yourself.
All right, so the journal is step one. Now, let's level up and look at two powerful mental models that professional investors use all the time to stay disciplined. The first one's called a premortem. Yeah, it sounds a little grim, but it's brilliant. The second you're ready to click buy, you stop. You force yourself to imagine it's 6 months from now, and this investment has been a complete and utter disaster. Then you ask yourself, why? What went wrong? This little thought experiment forces all the risks your overconfident brain was trying to ignore right to the front of your mind. Now this slide, this is a total game changer for how you should think about winning and losing. On the left, you've got a win, but it came from a terrible process, a random tip, zero research. That's actually a disaster in the long run because it teaches you that gambling pays off. Now look at the right, you have a small controlled loss, but it came from a perfect process where you followed your plan to the letter. That is a professional victory. So the key takeaway here is that long-term success isn't built on celebrating lucky outcomes. It's built by celebrating a good process. You should actually be proud of the discipline it takes to execute a well-managed loss, and you should be really, really wary of any profit that just came from a reckless gamble.
So we've talked about how to manage our fear and how to tame our ego. And let me tell you, those are two huge steps towards becoming a rational investor. But we're not quite there yet. There's still another big piece of this puzzle. So let me leave you with this final thought. Have you ever noticed how when you look at a stock, seeing that 52-week high number just completely anchors your whole perception of what that stock should be worth? Well, in our next explainer, we're going to dive deep into the brain's mental shortcuts and all the little information biases that trip us up, starting with that exact phenomenon. I'll see you in part 3.